If you're holding cash right now, you're losing money every single day, even if your bank says you're earning interest. And the longer you wait, the damage compounds permanently. Let me show you why holding cash feels safe, and why it's quietly the most dangerous position in this system. Cash feels safe for one reason: it doesn't move. Your bank balance looks the same tomorrow as it did today. No red charts, no volatility, no panic, no checking the news every morning wondering if you lost 10%. After years of inflation headlines, market crashes, crypto implosions, asset bubbles, real estate feeling overpriced and unreachable, cash feels like stepping out of the storm. And that feeling is powerful. When everything around you is unstable, when narratives are confusing, when experts contradict each other, cash feels like the only thing you can control. It's liquid, it's accessible, it's yours. No broker, no transaction fees, no waiting period. Cash gives you optionality, the ability to move when the moment is right. But here's what most people miss. Safety isn't about movement. Safety is about what absorbs risk. And when you hold cash, you're not avoiding risk. You're choosing which risk to absorb. You're just not aware you made the choice. Let's strip the emotion out of it. Cash is not money in the abstract. Cash is a claim on future goods, denominated in a currency issued by a state, managed by a central bank, diluted through policy. That last part matters, because unlike gold, unlike property, unlike assets with limited supply, cash can be created. Every time a central bank expands the money supply, every time a government runs a deficit financed by printing, your claim on future goods gets diluted. Not obviously, not dramatically, just quietly. When you hold cash, you are betting that the currency will hold purchasing power. Inflation will stay below your interest rate. The system will protect savers over borrowers. Tomorrow's money buys what today's money buys. That is a macro bet. Most people never realize they're making it. They think they're being neutral. They think they're avoiding decisions. They're not. They're opting into the rules of monetary reorganization. And those rules have winners and losers. Here's why cash losses don't feel like losses. Because they don't show up as numbers going down. They show up as smaller grocery bags, higher insurance deductibles, rent increases, delayed life decisions, shrinking optionality. Let's make this concrete. Let's use real percentages, the kind that work in any currency. Your savings account, 4% interest. Sounds reasonable. Sounds safe. Real inflation, the actual cost increases you pay, 12 to 15%, not the official 3.2%. The real cost of rent going up 8 to 10% per year, groceries up 15 to 20%, insurance up 20 to 30%, healthcare rising 10 to 15%, education, childcare, transportation, all rising faster than official numbers. Here's the gap. You earn 4%. You need 12% just to stay in place. That 8% difference? That's not market volatility. That's not risk. That's a permanent transfer of purchasing power. Let me show you how this compounds. Year 1. You start with whatever amount you have. It earns 4%. Costs rise 12%. Net loss, 8% purchasing power. Year 2. You start from a weaker position. Same 4% interest, same 12% inflation. Another 8% loss, but now on a smaller base. Year 3. The gap widens. Your ability to participate in the asset economy shrinks. Entry costs for housing, investments, security, all rising faster than your savings. Over 5 years, your balance might show growth, but your real purchasing power, what that money can actually do for you, has declined by 30–40%. Not in a crash, not in a crisis. In normal, everyday policy decisions. This is the silent transfer. If your cash earns 4% and real costs rise 12%, you're not losing 8%. You're transferring purchasing power from you to borrowers who pay back loans in devalued currency, to asset holders whose assets rise with inflation, to governments who inflate away debt, to the system itself. No crash required, no panic necessary, just time. Cash doesn't collapse, It erodes. Here's the uncomfortable part. Cash is safe for some people. Specifically, governments, who issue it. Banks, who multiply it through lending. Asset owners, who borrow against it at low rates. Corporations, who have pricing power. Institutions, with access to leverage. But for wage earners, for savers, cash is where inflation is passed through, policy costs are absorbed, stability is slowly taxed away. This is why, historically, cash favors incumbents. Assets favor insiders. Labor absorbs volatility. The system doesn't hate savers. It just doesn't protect them. Every reserve currency transition shows the same pattern. Let me show you two. Britain, 1920-1970. The pound didn't crash. Cash didn't disappear. Savings weren't wiped out overnight. They just mattered less every year. 1920. The pound is still the global reserve currency. British workers have jobs. The pound is stable. The empire is intact. Everything looks fine. 1925. Minor inflation. Nothing dramatic. Savers think, this is temporary. Things will normalize. 1930s. Depression hits. Prices fall briefly. Cash holders feel vindicated. See, we were right to wait. 1940s. War spending. Money supply expands. Prices start rising again. Faster now. 1950s. Pound is still a reserve currency, but purchasing power is quietly eroding. Savers don't notice because they still have jobs. The account balance is growing nominally. There's no single crisis moment. 1960s. Asset owners have consolidated. Property, stocks, foreign holdings, all rising. Cash savers are falling behind, but it's invisible. By 1970, British wage earners holding cash had lost 80% of their purchasing power. Not in a crash, not in a single dramatic moment, in a 50-year downgrade that felt normal the entire time. United States, 1971-2024. The pattern repeats. 1971. Nixon closes the gold window. Dollar becomes pure fiat currency. Many Americans hold cash thinking, this is temporary instability. What happened over the next 53 years? If you held cash, lost 86% of purchasing power. Even with interest, even with high-yield accounts. If you held real estate, up 400%. If you held stocks, up 5,000%. If you held gold, up 4,000%. Cash didn't go to zero. It just mattered less every year. Same pattern, different currency, different generation, same outcome. The transfer was complete before most people realized it was happening. And right now, the same pattern is running again. Not through collapse, through quiet reorganization. The real danger of cash isn't inflation alone. It's false patience. People holding cash are waiting for better prices, a safer moment, the crash, more clarity, the right time. But while you wait, assets reprice, ownership concentrates, access narrows, entry costs rise. Systems don't pause for observers. By the time it feels safe, it's usually expensive. By the time it feels clear, the transfer is complete. Cash feels like control. But in reorganizations, waiting is often the most expensive decision. This isn't about what to buy. This isn't a pitch. This isn't financial advice. This is about asking the right question. Not, is cash safe? But, who benefits when I hold it? Because once you see cash as a position, not as neutrality, not as safety, you stop confusing stillness with protection. You start seeing, your savings account isn't just a number. It's a bet on monetary policy, on inflation staying manageable, on the system protecting savers. And history shows that bet rarely pays. Next video. I'll show you why the people who survive these transitions aren't the ones with the best predictions. They're the ones who understand positioning. Welcome to Geopolitics of Money.